Hey everyone, welcome. We just got the closing bell for August 1st. I apologize for the fiasco this morning. Uh, I don't know what happened. I was having trouble yesterday afternoon. I think you guys know, and I think I had spillover effects this morning. I found out later that a bunch of you were in the room, and I got like five different recordings, each with different people in them, and then the one with just me in it turned out not to have sound. So I guess this morning, I think it posted anyways, but I don't know if it's useful because it's just silent. So we'll make up for it in this session. Let me share my screen and we'll take a look at what happened in the markets. So we had a really, really interesting day in the markets. We went way down in the S&P and in the QQQ. As you can see, our VIX did spike up at one point above the 19 level. So we'll talk about how everything played out. So remember, we are looking at 19 as a critical level for the VIX. If we go above 19, then we're not going to be too optimistic about this market, especially if we're above 19 and the S&P 500 happens to be below 540. Now, we were right at 540. We did break a tiny bit below 540 at some point today, and that is around the same time where our VIX did go above 19. So if we had closed there, that would have fulfilled our criteria for beginning to get bearish on this market. Now, that's quite a change because yesterday we were beginning to maybe be okay with being bullish on the market because we did close a little bit above that 550 level, but I said we had to be cautious because our VIX level was still elevated. Our VIX level was not above or below 15 yet. And oftentimes the day after a FOMC announcement, everything reverses. And we definitely reversed today. We reversed quite hard. We almost completely undid the move from yesterday. In fact, we did actually go below the low or sorry, the close of yesterday today. And then we did challenge that 540, but we recovered, but we are still closing below the MA50. So things aren't super great in in this picture. So you'll see a lot of news articles. They're talking about how the Fed signaled a rate cut in September, and the Fed needs to, like this and that, but they've signaled a rate cut in September. And I don't know what these guys are smoking because I watched that entire conference. I actually watched it twice to make sure I got the language of what Powell was saying. And he did a really good job of not answering anyone super, super directly and giving them a definitive answer. And so what I heard was that it's going to be data driven. It's not going to be data point driven. So any one piece of data is not going to drive their decision. They're going to look at the overall picture and the overall trend. So just getting a good CPI print, for example, isn't going to cause them to start cutting rates. And yes, they were getting more comfortable that we are approaching the time to cut rates, but not yet. And the decision wasn't made yet. And it was going to be dependent on a pool of data. So that none of that speaks to a rate cut to me in September. But who am I to argue with the market? The market's going to trade the way it's going to trade. And it'd be silly for me to say, hey, we need to short this when this is clearly moving very, very strongly upwards. So what are we going to do in terms of bonds? If we are going to trade bonds, then I will wait and see if we pull back and challenge this level, and then if we bounce or we move down. Now, that it will be at some point, everything's got to resolve. We go to September and there is no rate cut. Well, this is going to be a huge, huge, huge problem for the markets. But if there is a rate cut, then how many it's already priced in? How much more of a boost can we get? There's also the interesting actually. So my background is specifically in the fixed income, and in the later half of my career I was specifically short-term money markets, and we were specifically focused on exactly what the Fed did on each one of its announcements. So this was my realm, my responsibility. Within my purview of being able to interpret what the Fed was doing and what the market was doing in response to the Fed. So what is interesting that maybe not a lot of people are thinking about is, oops, I should stay on TLT, is that there is potentially a pocket of bond traders who are uncomfortable with a cut in rates and they don't want it. And so if those guys start pushing prices up in the bond market, then it's as if we got a rate cut. If they start behaving as if we got a rate cut, then the Fed might go, oh, we don't need to cut rates. The market's already equilibrating itself as if we had cut rates, and then they don't take any action. So that's a little kind of underhanded, under the radar move. If this is in fact what is happening by the bond market, I still know guys in the bond world, so I'm going to be having some interesting conversations this weekend. We'll see. We'll see what happens. So in that case, even though we are not expecting a rate cut in September, the pricing is behaving as if it's expecting a rate cut in September, potentially to try to influence a FOMC decision later on in the year. So that we could be playing those games. It's just so we are aware of everything. So if I go back and look at that SPY, we really don't want to get bearish unless we close below this 540 and that VIX is above 19. Can that happen? It can definitely happen. If we can swing like this over the course of 2 days, all the way up, all the way down, in effect, this is just a little bit wider range than I anticipated of a chop sideways. If I look at this day right here, Wednesday, July 24th, here we are a week later, exactly 1 week later, and we are just barely above that level. We basically just chopped sideways, or if you could also say that we basically traced the MA50 upwards. That's it, and just a tiny bit. So we're not ready to make any decisions one way or the other. The earnings today after market could influence that and force us into one direction or the other, especially since we got some pretty big cap stocks reporting. So if I remember correctly, Amazon and Apple, and we'll see if there's any others. Today after close, we've got Apple and Amazon. Vertex, that's pharmaceutical. I don't know what MUFJ is. Mitsubishi Fire. I don't know if anyone's following that. We have booking.com. That is like gambling site, I believe. So consumer discretionary. Nope, I'm wrong. Travel, still consumer discretionary. Intel, that's going to be very important for chips. Melly is, I think they do clothing, retail clothing. Motorola, they're going to be in the communication sector. Monster Beverage, that is consumer staples. We've got Coin, that's crypto related. Mchip, another semiconductor. We have Team, that's a software, business to business type of software. We've got DoorDash, so consumer discretionary. We've got some pretty big Square. We've got some pretty big ones coming out, but of course, Apple and Amazon are going to be the most important. And in a few minutes, we'll see if they've already released and how that might influence us. At this point, because we've basically already priced in 100% chance of a rate cut in September, then it's not that relevant anymore. So at this point, we're playing with 100%. Then we're playing with basically 100%, and then we're playing with basically 100%. So if you take the probabilities across these three, what it is saying that, I did this morning, I won't spend the time to do it again, even though it was muted. The conclusion is that September, we're basically pricing in 100% rate cut. And between November and December, we are pricing in a second rate cut at about 70 to 80% probability. So I don't know, but once we start cutting, the Fed operates in programs. It's not just going to cut, skip, 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 cut, skip, skip, cut, skip. They once they cut, they tend to cut steadily. So they'll cut and then they'll cut and then they'll cut and then they'll cut and then they'll pause and see what happens. They're not going to just skip a few, and then once they start, it'll be programmatic. So uh, this is because we priced in 100%. That means that no matter what kind of data that we get, we've already come to our conclusion as a market that we're going to have a cut. So we're going to become less sensitive to CPI, PPI, things like this, unless the numbers just come wildly away from expectations. So now at this point, I'm not putting as much importance into the report on Friday, the employment situation report. Is going to take a backseat to earnings. So really, especially the Amazon and Apple earnings, those are the ones that we really, really want to watch out for this week. And then we'll consider, well, actually, we'll see next week, see what we have. A BRKB, that is Berkshire Hathaway, that is Warren Buffett's. Eli Lilly, Novo Nordisk, so two very important healthcare stocks. Amgen, another very important healthcare stock. Disney, they haven't been doing that well, but Disney. Then we got a consumer staple and Cat, Uber. Yeah, we still have some pretty important stocks next week. So the earnings are going to start to take more priority. They're going to be more important in deciding what happens to this market. So let's take a quick look at our sectors. So we did have this big sell-off in the indices. So we want to see, is that mainly SMH? Is that mainly QQQ type of stocks? Or did we get a broad-based sell-off? So where's my stock filter? There we go. Okay, so utilities were up, real estate was up, healthcare is up, stable. So defensive, except for real estate, which is kind of interesting because the actually no, it would same direction as bonds. That's not to be surprised. That's not surprising, I should say. Communications surprisingly up, but not much. That's more like random. And then we've got some biotech, some staples that are at the verge of being non-random. Then we got financials down, defense down, industrials down, discretionary, retail, energy, small caps, home builders, technology, and SMH led the way down. Okay, so it is pretty broad-based, but there is an extreme in SMH and technology and home builders and small caps. These are all, I mean, even these 2% ones are pretty big, but there's a clear delineation in SMH. And then technology and home builders are similar. So let's take a quick look at that. SMH. Okay, so this is what we were talking about the last couple of days. We have been following this trend downwards where we have a surge downward, then a bounce or a chop sideways into the EMA 8, a surge downwards, a bounce or chop sideways into EMA 8, a surge downwards, bounce back up to the EMA 8, and now we're surging downwards again. This is not a great pattern for SMH. This is not inspiring confidence. The only thing is that we're right at support, which is why we've touched this level 3 times now. So will that support hold? We'll see after Amazon and Apple earnings. We'll see. It might be pretty heavily influenced by those two, although chips are going to be a little bit more independent. So we were probably going to look at more at MChip. Is that the one that was MChip? No. This week? Tomorrow before open? Tomorrow before today after? Where did I see MChip? MChip. Yeah, MChip. And I think there was one more. Motorola, maybe. And then tomorrow before market open. I guess I didn't look at this one yet. So we got some energy stocks, some pretty big energy stocks tomorrow morning. And then next week. I guess basically Mchip. So Mchip will have a bigger effect on SMH than Apple and Amazon. Those will have an indirect effect. Those will operate more on XLK. So XLK looks very much the same as SMH. We have a clear support where it's bouncing off of. We could call that twice or maybe 3 times. And then this MA150, which coincides with this area of support right here. There's a lot of support right here. So we'll want to see what happens with Amazon and Apple. So let's take a quick look at that. See if we can get a clue. Amazon down, but not hugely down. 184 down to 186, so not even 5%. So that is okay, but it is a downward pressure. And then we'll see if it stays this way by tomorrow, because this is the same thing that happened to Microsoft. Microsoft was down huge and then it recovered in the Asian markets. And then we got Apple, but today they may not feel the same way because of how we had this downward pressure, downward surge. Apple, that's interesting. Is Apple not? Yeah, it is reporting. Today is August 1st. Yeah, it should have reported. I guess not. Interesting. And okay, I guess that maybe closer in another 15 minutes or so, we'll be able to see Apple. Okay, so I don't think we're going to be talking for another 15 minutes. So on your own later tonight, you can take a look, or tomorrow morning for sure, we'll take a look at what happened with Apple earnings and the effect that it might have on the markets tomorrow. So right now, Apple and Amazon, they're probably going to have a stronger effect than anything else in the market right now. That employment situation, like I said, became less important after we got, we continued to stay at 100% on September rate cut. But again, remember, the whole market and the news are saying that they signaled a rate cut in September. But if you carefully examine the language, they did not. So that employment situation number, that all that data could come back into play if it starts to give people a sense that we shouldn't be pricing in 100% chance of a rate cut in September. But for now, it's been sticky. It's been like that for, I think, at least a month. So if the announcement didn't change it, then it would have to be some pretty drastic data to cause the markets to start pricing in the possibility of not having a rate cut. So I wouldn't count on that just based on tomorrow's employment data. So we're really going to want to watch Apple's earnings when it comes out and see its effect on the S&P 500. Right now, everything just seems flimsy, and it's time to be cautious, to have hedges in place, or just be in all cash. And I know I've said that all week, and sometimes people are like, "Oh, when can we trade?" And you're just sitting there in cash and there's no action. It's boring. Yeah, but we're here to preserve our capital and make money, not to be entertained. So if you want to be entertained, you can take an occasional tail risk trade, a higher probability, or I guess relatively low probability, but higher than normal probability, and a huge reward risk ratio. That way you can play. So I took a tail risk trade on my personal account on Starbucks after earnings. I was counting on it going down, and it went way against me. But today the market saved me. So that what made it a tail risk trade was that I knew that it would probably, if it went up, the market will probably bring it back down. But if it went down, that was in my favor. And then if the market continues to go down, then it would push it even deeper in my favor. So that's what makes it a tail risk trade. There's limited risk on the upside and huge potential to the downside. And we can see that right here, we closed at 75. I'm just almost at break even because of it. So basically, if I entered here and went way up and then came right back down to where we were, then I'm almost at break even, right? I only have to worry about time decay. So those are the types of things that I mean for a tail risk trade. So since we're really just waiting for Apple, and that's not going to report for another 10 minutes, I'll end it there, and we can look in the morning and see how Apple is trading the markets. All right, have a wonderful rest of your day, and I'll see you tomorrow morning.